Hello, I'm Todd Rosenbluth, Head of ETF and Mutual Fund Research at CFRA, and we're excited to walk you through our ETF rating system that we launched in 2020. Specifically, we're going to focus on the importance of what's inside an ETF and why that matters. Before we go too deep into our ETF rating methodology, I wanted to help you understand how it fits in to all the work that CFRA does, focus on fundamental and forensic accounting. You can see at the top of this pyramid, we've got market commentary, and towards the lower half, we've got individual company research, idea generation, and portfolio risk monitoring. What we're doing is combining our coverage of individual stocks, 1,500 qualitatively and over 25,000 quantitatively, to help us to form an opinion about an individual ETF, offering a prediction or a projection of how that ETF is going to perform in the next 9 months. As we move further through the deck, you'll see here that we at CFRA are an independent research provider. We do not have our own ETFs. We do not manage money. We don't have an asset management arm, and our ratings are truly independent. In fact, we have one ETF that's out there that is tied to a CFRA index, and we don't have a rating on that. We truly believe it's important for you and your clients to understand we are an independent research provider with no conflicts to disclose. Now, as we move here, you'll see the way that CFRA rates ETFs is quite different than others in the industry. We're combining both fundamental and forensic accounting to offer an assessment of what's inside the portfolio and offering a more forward-looking view than others within the industry, specifically looking at the reward and risk characteristics of a portfolio. We think what's inside a fund will drive its future performance, and that's why our experienced and detailed fundamental and forensic accounting analysts, more than 70 analysts in total, do a great job of picking stocks, understanding the risk mitigation that's out there that a company has from an earnings quality perspective. That helps us to form an opinion of what's inside the portfolio. We'll combine those metrics with more ETF-specific characteristics to understand the cost and the risk of the overall ETF. As we show here on the screen, this ETF is scoring as a 5-star. This is the way that we are rating ETFs, consistent with the way that we rate mutual funds and our individual stocks. For ETFs, we're evaluating the prospects and likelihood of their outperformance over the next 9 months. That's a little bit different than the way that we rate mutual funds. You can see on the side of the screen, we've got a breakdown of cost, reward, and risk. All of these are scoring higher than average. The score is greater than 50. Specifically, the cost of 75 shows you that this ETF is among the least expensive ETFs. A high cost score means it's relatively cheap. Similarly, a high risk score of 56 means it's relatively safe. The reward is as simple as that. The reward potential of this ETF in order to go up more than its peers differentiates itself from the alternatives. We break down ETFs into 4 categories. One is fixed income. All fixed income ETFs are rated against one another, and the highest scoring ETFs, the ones that have the best cost, reward, and risk scores, get 5 stars, down to 4, down to 3, down the line. Within equity ETFs, because that universe is so broad, we've broken it down into diversified U.S. equity, U.S. sector equity. These are ETFs that are more concentrated in one individual sector, and then global equity, which is combining both international stocks as well as one ETFs that combine international and U.S. stocks. And we have a different model for each of these 3 categories because the ultimate driver is quite different. Now let's go a little bit deeper and give you a sample of one of our CFRA 5-star rated ETFs so you can understand not only what drives it, but how to best utilize their report. We're going to focus on the Consumer Staples Select Sector SPDR, XLP. This falls under the category of a sector equity ETF, and it gets a 5-star rating. In fact, this was the sample we were using earlier. So the cost of 75, the reward of 69, and the risk of 56 is all being driven specifically to XLP. Cost is simply looking at its expense ratio relative to its peers and how the ETF trades in line with its net asset value. A reminder, unlike a mutual fund where you pay the net asset value, when you're buying or selling an ETF, you get a price that often can be different than the net asset value of the portfolio. and that is a real-world cost. The 13 basis point expense ratio for XLP is quite simply among the cheaper funds around within the sector space. When we look at the reward characteristics of the portfolio, we also want to be able to look at what's inside using CFRA's assessment of the stocks using our qualitative analytical team and our forensic accounting team. The qualitative analytical team shows that 6 of the top 10 holdings are either buy or strong buy recommended companies. And we'll show you on an upcoming slide some of those specific companies. From a risk standpoint, you can see that 7 of those top 10 holdings are in favorably low CFRA earnings scores. Quite simply, it means that the earnings record shows there's likelihood of earnings potential as opposed to the company masking some of their problems. The other metrics that we use outside of CFRA's proprietary STARS and proprietary earnings quality assessments include the fund flows. We'll do some additional analysis using the income statement and balance sheet, and a focus on short and intermediate term performance. Let me just specifically focus on XLP from a fund flows perspective. This ETF has gathered more than $1 billion of net inflows during 2020. That shows you that there's investor interest, the sentiment is positive. That can help you understand the reward potential of an overall ETF. If others are interested in buying it, there's likely to be continued activity driving the ETF even higher. Before I go deeper into the individual parts of the report, I'd be remiss if I didn't tell you that CFRA did a lot of back testing on our ETF rating methodology. Now, no back test ever sees the light of day unless it shows up as favorable attributes. But we're specifically proud of the fact that our model, with again 4 different models for each of the categories, not only worked where our 5 stars outperformed the average, the 1 stars significantly underperformed the average, but you have a nice delineation between the 5s outperforming the 4s, outperforming the 3s, and so forth down the line. Specifically to XLP, you can see 5-star rated ETFs did over 200 basis points better than the overall average, and most importantly, the 1-star ETFs, the ones we think have the least likelihood of outperforming, were up only half what the returns for the overall average was. So you can have confidence that the model that we've put forward for our ETF rating methodology has rigor behind it. We've got confidence, and as we update our research on a month-to-month basis, as we make our way further into it, we will show you a live track record. As we're recording this in late April, we only have 2 months of history and not enough to be able to show you how we've done in the real world, but we're excited to be able to do that in the coming months. Let's move a little bit closer down the report. Specifically, the bottom of page 1 shows you a comparison of the specific ETF in question and some of its peers. In this case, this is a consumer staples ETF, and we're showing you what our view of this ETF is versus some other consumer staples ETFs. VDC, which is a Vanguard product, and FSTA, has a 5-star rating. These are 2 market cap weighted oriented ETFs that have exposure to small and mid cap companies. So not just having exposure to Procter & Gamble and Coca-Cola, but also companies like Treehouse Foods and Hain Celestials. FXG and RHS, these are smart beta ETFs, alternatively weighted. They tend to have higher fees, and the positions are going to be different. Either the weighting of the positions are going to be different, or the underlying stocks inside are going to be different. In the case of RHS, that's an equally weighted version of the consumer staples sector, and so it actually has more exposure to Smucker's and Church & Dwight than you'd find in Coca-Cola, as opposed to Coke being among the larger consumer staples companies around. We make our way to the second page of the report. You get a deeper dive into the underlying holdings and what does CFRA think of those underlying holdings. In the case of XLP, more than 70% of the portfolio are among the top 10 holdings. So this snapshot gives you a great assessment of what we think from not only a valuation perspective, that you'll see which stars, again, the more 4- and 5-star rated, the better, and from an earnings quality perspective. So 7 and below to us are companies that have understated earnings potential. And you can see Coke, Costco, Kimberly-Clark, Philip Morris International are examples of companies that are viewed undervalued according to our qualitative equity analysts. And companies like Mondelez and Procter & Gamble are examples of companies with understated earnings potential according to our look at the last period of time, looking at the income statement in more depth and trying to find out if the company is hiding some of their accounting efforts. Equally as important, we found that the third page of our ETF report can be a good snapshot of what our favorite ideas are across various sectors, investment styles, regional perspectives. I'm showing a snapshot of that. We're only focusing in this screen on the sector ETFs, specifically the ones that you might want to pair with XLP. You should view this as in rank order. So under consumer staples, even though we're highlighting the consumer staples select sector spider, it is actually the third most favored of our consumer staples ETFs under coverage. We happen to like Vanguard and Fidelity even better than we like the consumer staples sector spider. And you can find that just by looking at the report. But similarly, even though Vanguard is cheaper, has a lower expense ratio than the State Street product, Vanguard is not the top ETF across all the various categories. You can see in financials, in healthcare, in consumer discretionary, in real estate, there are other ETFs from other providers. So we are not just favoring one ETF provider over another, and certainly not favoring it just because of its fee. There are nuanced differences between these ETFs, and you can use this as a cheat sheet to figure out what ETFs and what ETF reports to pull up and learn more about. Now, just to sum up, I wanted to align you with how our overall views are. We shifted earlier in 2020 to a STARS rating methodology and have updated methodology inputs. Specifically, we've combined our forensic accounting earnings quality assessments to our analyst-driven qualitative assessments of the stocks to offer a proprietary holdings-based assessment. We've similarly shifted our rating methodology to a five-star system, which is consistent with the way that we look at stocks as well as our mutual funds. But to reiterate, our mutual fund rating methodology is done independently from our ETF rating methodology. But what we do with both of those is leverage machine learning techniques. So our ETF model, month to month, gets smarter over time, understanding the risk and reward characteristics of the current environment. And what we use to drive this is our own proprietary FirstBridge data. FirstBridge is an ETF company, ETF data company acquired by CFRA in 2019, and it's allowing us to have ETF-specific peer group comparisons. Sector ETFs, as well as smart beta ETFs, thematic ETFs, regional ETFs, we've got great data that is powering this from a proprietary perspective. We're really excited for you to get a closer look into our ETF rating methodology. If you have questions that we didn't cover on this presentation, you can contact us at cservices@cfraresearch.com, or you can call us at the number that you'll see on this screen and this upcoming screen here, 1-800-220-0502. Thanks, and have a great day.